Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, bonds gain and equities hold steady as US inflation data reinforces expectations that the Fed will cut rates this year. Pendal Group's head of income strategies, Amy Shear-Patrick, joins us to discuss whether the AI-related angst in equities will further boost bonds. China's president stresses stability in his Lunar New Year message after touting domestic demand as the main driver of economic growth. In India, the central bank tightens rules on loans to brokerages in its latest move to curb speculative market activity. And we'll hear exclusively from US Secretary of State Marco Rubio as he delivers a warning to European leaders at the Munich Security Conference. Let's take a look at where markets are at this Monday in the Asia Pacific. It is a bit of a mixed bag at the moment. We're seeing some modest gains there on the Hang Seng Index. Technology stocks are still under pressure, though. The Hang Seng Tech Index off by 0.8%. The Nikkei also softer by 1/3%, although we are looking at Nikkei futures there. The oil price coming off the back of a weekly loss continues to slip. We got Brent crude at 67.74 at the moment. President Trump said on Friday that regime change would be the best outcome for Iran, but the US and Iran will hold more talks in Geneva this week. The president saying negotiations could go on for a month. Gold, which was briefly back above 5,000, now dipping just below that level. Well, traders are pricing higher chances of more than 2 Fed rate cuts this year after US inflation posted its smallest monthly gain since July. For more on this, let's get to Garfield Reynolds, who leads our Markets Live Asia coverage. Garfield, too soon to say inflation is defeated in the US?
Well, definitely yes, it's still significantly above the Fed's target, but it is moving in the right direction. There's a nice contrast with what's been going on here in Australia, where the RBA obviously thought that inflation was getting under control, hence it carried out some rate cuts, and then it came roaring back and they've been forced to reverse. The Fed is facing no such impetus right now. It has been concerned about tariffs, about some signs at some stage that there was some stickiness in the data, but it's continued to track lower, and that fits with the idea, which is very prevalent in the market, that there will be rate cuts, although that they will probably not take place until after Jerome Powell steps down, as he's scheduled to do as Fed chairman at the end of May.
How about the other side of the equation in terms of the job market? Because we've seen some resilience there, but are there hidden risks?
Well, the hidden risk is that while January's jobs were impressive, the revisions for 2025 were much less so. Had very weak growth there, and you had a very strong concentration of January job growth in healthcare in particular. So there's a lot of doubt that the apparent strength in the jobs market in the US is truly enough to hold up. And at the same time, you have the Fed itself, as it currently stands, forecasting that rate cuts will come later in the year because inflation is coming down. You would need to get either a rebound in inflation or an extraordinary resurgence in jobs growth to justify the pause maintaining till the end of the year. If you get inflation continuing to go where it's been going, you get some resilience in the jobs market, but it's still not going gangbusters, then that would, the various Fed speakers have said they think that current settings are still slightly restrictive. So then it would make sense to ease down without bringing on the sort of rapid and deep rate cuts that the president, for example, has been calling for.
Well, a lot of the Fed speak that we've heard up until this date has still been somewhat hawkish, warning about the risk of inflation becoming resurgent. Considering the recent CPI numbers, do you expect that language might begin to take a more dovish tilt?
I think they'll still be quite concerned about wanting to be sure that inflation is fully tamed. Remember, this is a Fed that's lived through an experience where it said that inflation was going to be transitory, that it could delay rate hikes, and then ended up having to hike rates faster and higher than any of them expected because inflation got so drastically high. Took a long time to come down. So they're not going to be in a rush to cut unless the jobs market seriously deteriorates.
What are we seeing in terms of action on the yield curve as well that suggests what the path ahead is going to be like?
Well, the yield curve is sort of a little bit stuck. It gets a bit steep, then it comes a bit down, and that's because you've got this base case of rate cuts are coming, but not quickly. You've also got a situation where you're not getting either the inflation or the growth impetus to seriously drive the longer end of the curve higher. You've also had something of a shock in the way that the JGB curve has gotten under control after Takaichi's very strong election victory, led investors, at least for the moment, to pair their bets that there would be massive fiscal stimulus imprudently funded. So with that going on, you've got both ends of the US curve a little bit anchored right now.
All right, Garfield Reynolds, who leads our Markets Live coverage, thank you so much. Let's get some more on markets. Amy Shear-Patrick, head of income strategies at Pendal Group, joins us as well. And Amy, I just want to pick up with those US CPI numbers. I mean, we do see inflation starting to moderate, some encouraging signs there. Do you see a trend emerging?
It's a bit too early to call an overarching trend, although I would argue that, the US inflation picture, it's been sticky, but it's not been catastrophic by any means. I think, within our own forecast, we'd picked up a likelihood that US CPI numbers were going to slightly be softer than the consensus was expecting, so we positioned for it, and I'm really glad that that turned out okay. In terms of ongoing look at US inflation, I mean, I actually think that, it might be a little bit too early to be positioning for more rate cuts than what is currently priced in by the market, purely because, everything that Garfield just said, you're seeing slight softening of the labour market. That trend has been continuing for over the past year. That trend will continue, but I don't see, the labour market falling off a cliff anytime soon either.
Garfield also suggesting there that there's not going to be any change until Jay Powell has left as Fed chair. Is that a view you would share?
I think the Fed will change depending on the data that it sees before them. I don't have any strong view about whether the Fed is stuck in terms of being able to make any policy decisions, before that date. Again, I think that the data that's in front of them tells them that inflation is well under control and it will probably slowly continue to descend. The jobs market is still continuing to loosen, so by all measures, a gradual continuation of the easing cycle is probably the most prudent thing to do.
Do you feel like this last mile of inflation is being underestimated at all by the bond market?
That's a really interesting question, and I've been asking myself as well, because especially in Australia and in what Garfield just mentioned, our inflation picture has kind of seen things go a little bit the opposite way of the US of late. And I asked myself, what is so different that has caused this inflation surge, or this apparent inflation surge to happen in Australia? I actually think that, the Australian inflation patterns and the leading indicators we look at, whether it's jobs in Australia, whether it's how wages are going, whether it's even, the key components like housing, dwelling, that's been causing inflation to be sticky in Australia, they're temporary and they'll wash out. So I don't really see Australia as a canary in the coal mine, per se. I think the overarching trends for inflation is if job markets continue to stay stable and loosen on the margin, then inflation will continue to come down.
Is it a good time to get back into duration?
I have been stepping a toe in. I wouldn't get overexcited, only because I think a lot of the bond positive momentum that you've seen in markets over the last week or so, yes, it's partly been fueled by the data that we've been seeing coming out of the US. So you had, US retail sales missing slightly to the downside. That surprised markets, and certain elements of the labour market data, such as jobs, for example. But I think a lot of it has been fueled by this fear in the equity markets about what AI will do to certain parts of equity markets that have done particularly well over the last year or so. I just wouldn't take that bearish sentiment too far. So if you want to lean long duration purely because you're worried about what AI is going to do to equities, I'd be a bit careful about that.
I think everybody's worried about what AI might do to everything at the moment. I mean, let's explore that a little bit more. I mean, because you talk about the K-shaped economy, as many do, the AI and the rest, particularly on the consumer side of things. So do you see that driving a bit of a split between the way US Treasuries perform and the way high yield credit performs?
Oh, yeah. I mean, the K-shaped economy, I've got my own views about that. I think it's playing out rather differently. If you look at, again, the performance of the Russell versus the performance of the S&P 500, it's saying something quite different. But yeah, high yield, US high yield in particular versus treasuries. High yield seems to be a bit of a smelly place in some ways, partly because credit spreads globally are at the tighter end of their cyclical ranges. And US high yield is definitely somewhere where AI-related capex spend over 2026 and, to be honest, the next few years is going to be looking for additional sources of funding. Again, I would say that if you're an investor looking to take advantage of the newest and brightest and shiniest thing, you know that by chasing after something like that, you potentially risk a lot as well. I mean, in this AI game, we don't even know whether it's a winner-takes-all game yet, let alone who the winners and the losers are going to be. So in high yield, I do think it's a little bit risky in the near term, just because as a debt investor, why would you want to cap your gains at, coupons plus par when you could potentially in the equity markets, multiple X your money if you get the call right?
Mm-hmm. Let's move back to the rate environment a little bit closer to home, because we've got a number of central bank decisions this week. New Zealand, Indonesia, the Philippines as well. New Zealand, Indonesia probably a hold, maybe a cut in the Philippines. Which one of these are you watching? Is there any chance of a surprise from any of them?
Not materially, I would say. And the general pattern in the region, barring Australia again, has been we're probably getting to the end of any easing cycle, if they've implemented an easing cycle. We're still watching inflation indicators. We surely don't want to see the patterns in inflation that Australia has seen. And so central banks are starting to exhibit some more caution at this part of the cycle. And it goes back to what Garth and you were talking about earlier about yield curves being relatively stuck, right? At this point of the cycle, where central banks are watching to see what will now happen after all the policy that they've implemented is washing through the system. The yield curve is watching for signals of, well, is inflation under control, or are economies about to show cracks as well?
Let's talk a little bit about Japan as well, because we've got fourth quarter GDP numbers today, somewhat anemic, but it was a return to growth, so let's take it. Household spending was not fantastic. Do you think there's enough here to give the Bank of Japan confidence to continue along that normalization path?
I mean, the Bank of Japan's decision, I think, is somewhat more complicated than just the economic data, right? Every time they've tried to raise interest rates, well, not every time, but several times, we've seen the markets overall stumble. And not just for Japanese markets, but it sort of sucks in the global market vortex as well. And I think because there are so many layers to the Bank of Japan decision, I don't think this print enough will be necessarily the green light to say, okay, let's now hike every 6 months until we see policy normalized.
Or we get another key piece of data later this week with those CPI numbers out of Japan as well. And I mean, that's seen starting to moderate also. So what's your outlook here, and can it get to the Bank of Japan's target?
Again, it depends on how the rest of the world's risk appetite, I think, is shaping up as well. I think the inflation picture, central banks have typically demonstrated, as much as they talk about being forward-looking in the way that they act, they typically demonstrate a behavior which is quite backward-looking. And I don't think the Bank of Japan is any different to that. So, yes, they should have. We could talk about how much they should have hiked by now. But again, with inflation starting to come down, and if there is, I suppose, a global strike against this policy action, I think it will limit the BOJ's ability to act.
In terms of should have hiked, did they move too late? Was there a policy mistake?
I think so. Yeah.
What should that timeline have been like in terms of its aggression?
I mean, very much in terms of how you saw, other major central banks react to inflation unfolding in front of them. If you think that, even central banks like Australia acted a little bit too late, and you could definitely make an argument for that, then, with Japan, as they saw inflation start to creep into their economy, and not just a blip, but definitely something that would become a trend, they definitely could have gotten in front of it a little bit earlier.
The Australia question is an interesting one. Maybe we can come back to that in a second, but where's the neutral rate in Japan? Because we heard from one of the board members, I think it was Tamura, saying it's 1%. Would you share that view?
Paul, you and I have had conversations about neutral rates in the past. I don't give them too much thought because, again, I think it's a very academic concept. And it's a concept that central banks do like to hang on, but, it's only something that can really be observed way later. So I'm afraid I don't have a good answer for you to that question.
I'll let you off the hook, but I do want to ask you about JGBs. Maybe we're on some firmer ground there. Do you feel all that upheaval we had last month is behind us now? Are we done?
No, not at all. I think the long end of every curve, not just the Japanese curve, has been starting to show what being de-anchored looks like. And I think ever since the pandemic hit, global fiscal regimes are seeing a new era. And as long as there is the possibility that there could be more fiscal, or there could be at least more fiscal leniency, and at the same time, if globally we're not in a place economically for everybody to be running for the hills in terms of protection, that long end becomes a little bit sort of free-flowing, and according to the market winds. I mean, a prime example to look at is how demand for long-end UK gilts, for example, has changed as defined benefit pension schemes have rolled off and the demand for very long-term UK debt has faded. So I think, again, when you lose these structural anchors, these structural demand anchors to the long ends of curves, naturally you're going to start to see risk premia come in more to those parts of the curves.
Well, look, let's get back to Australia, because rates are increasing here again, which I don't think really was anybody's bingo card a year ago.
Not mine.
So, did the RBA make a mistake?
No, I don't. I think for all the evidence that they had in front of them, where is the mistake if you were to isolate a mistake? Did they make a mistake in their forecast, and therefore they had to show some policy action because relative to what they had forecasted, the reality came in very different? Again, it's not my place to say whether our central bank made a mistake, but do I think that this is the beginning of a new hiking cycle where we're going to see multiple hikes? Again, I don't see that urgency in the momentum of inflation in our economy to warrant that. So maybe it's fine-tuning. I'll put it down to that.
Well, we do have jobs numbers this week as well, and the unemployment rate seem as creeping up, so that's the other half of the dual mandate. Is there an argument for just being one and done, or do you think we're going to have another rate increase in May, possibly August?
So I've heard arguments of RBA observers saying, the RBA typically doesn't move one and done, and if they've decided to do something in the opposite direction to what they've just been doing, then typically they'll follow it up with something else. I do think, though, that this RBA, especially the way Michelle Bullock talks at the press conferences, tells us that they're just watching the data as it unfolds before them. I mean, you mentioned jobs this week, but we've also got wages coming up as well, and wages, we know, is whether you like it or not, one of the primary things that the RBA is looking at right now. So when you look across to see various major bank indicators of how wage growth is going in Australia at the moment, even if you look at the data on websites like seek.com, it's not showing you any sign that wages are running away. Far from it. If anything, they're going the other way. So I think it may well be a one and done. And if it's not one and done, I don't see it as the first hike in the series of, let's say, 5 hikes to come.
All right, Amy, thanks so much for joining us today. That's Amy Shear-Patrick, Head of Income Strategies at Pendal Group. Still ahead this hour, China's president emphasises stability in his Lunar New Year message, also touting domestic demand as the main driver of economic growth. We'll have details of that story next. This is Bloomberg. Welcome back. You're watching Insight. Chinese President Xi Jinping is emphasising a focus on high-quality growth this year in his annual speech before the Lunar New Year holiday. It's the second consecutive speech where consumption and innovation-led growth were named as priorities. For more, let's get to our Chief North Asia correspondent, Stephen Engel. So, Steve, what stood out in these speeches?
Well, essentially that Xi Jinping wants this new development paradigm, if you will. It's sort of vague, and that's what these Lunar New Year speeches are all about. They're sort of broad brushstrokes about the direction of policy going forward that will then be sort of finalized at the National People's Congress in Beijing in early March. But the Lunar New Year holiday speech, plus this other speech, which we just got basically delivered by the top journal of the Communist Party, Qiu pressure that came from the Central Economic Work Conference in December behind closed doors, but we just got that downloaded essentially now. So 2 consecutive speeches over the course of the last couple of months that really emphasizing social harmony, stability, and this new development paradigm, which, let's face it, China did really well through the headwinds of 2025. GDP came bang in line with what they expected, 5% GDP growth for the full year, despite the trade headwinds from the Trump tariffs, the ongoing tit-for-tat issues between the two countries. They leaned on exports. The record trade surplus was emblematic of that. So that new development paradigm essentially is that shift towards more innovation-led investment and, of course, domestic consumption. They need to get the households to spend more, and they need confidence in the household to spend more, and maybe de-emphasize the exports and de-emphasize, obviously, the ongoing issues with property. Xi Jinping, in that speech from the Central Economic Work Conference in December, essentially called this, we need to take advantage, leverage the advantages of China's super large-scale market. So that has multiple elements to it, obviously, attracting foreign brands to come into China, get people to spend more, and get that part of the pillar of the Chinese economy going. So that's going to be likely, as we've heard again and again from the Chinese top leadership, domestic demand is going to be a top priority in 2026.
Well, we've also got the US Secretary of State Marco Rubio meeting with his Chinese counterpart Wang in Munich. So what's being said about how the truce is holding up between the two countries?
Well, so far, so good. They both agree that there needs to be more dialogue. And again, they're trying to figure out and trying to put in the building blocks for this proposed summit of Donald Trump going to Beijing or China, probably Beijing in April, whether it's the first week or later in April, we don't know yet. And also both sides need to work on the deliverables. Are you going to start tackling those really contentious issues that the truce extended till this coming December? Or are you going to find some lower-hanging fruit where they can find those deliverables for each other? Now, there's going to be a lot of different issues, no doubt, with Donald Trump castigating Mark Carney going to Beijing, and then again, Keir Starmer of the UK going to Beijing, striking some other kinds of arrangements with China. And our editor-in-chief, John Micklethwait, had a sit-down exclusive interview with Marco Rubio, the U.S. Secretary of State, on the sidelines of that Munich Security Conference, and didn't begin by asking him, but among the many issues that they talked about was whether he was concerned, the Secretary of State was concerned, that this indicates sort of a drifting of key allies, traditional allies of America, closer to Beijing.
In this very forum yesterday, I met with my counterpart, the foreign minister of China. So we expect nation states to interact with one another. I think it would be irresponsible for great powers not to have relationships and talk through things, and to the extent possible, avoid unnecessary conflict. But there will be areas we'll never agree on, and those are the areas that I hope we can work together on.
Now, very quickly, separately, Wang Yi also touched on the issues with Japan, calling Takaichi's comments for Taiwan essentially ghosts of militarism, and he said it's a very dangerous situation.
All right, Bloomberg's Chief North Asia correspondent Stephen Engel there in Hong Kong. Still to come, India's central bank cracks down on high leverage trading firms. We'll break down what tight new rules could mean for profits and the cost of capital. This is Bloomberg. Welcome back. You're watching Insights. Here's a quick look at where markets stand. It's a holiday-interrupted week in much of Asia this week. We've got Japan on the lunch break at the moment. The Nikkei off about 0.25%. Japanese bank stocks are kind of undermining overall sentiment there. And we got a GDP result out of Japan that was, well, let's just call it anemic. It was weaker than the economist median estimate of 1.6%. Consumer spending was really bad, growing just 1/10 of 1%. So it just shows how fragile domestic demand is in Japan. However, there is a lot of fiscal spending due to come from the Takaichi government, and the Prime Minister, Sanae Takaichi, will be meeting the BOJ chief Ueda later on today. Well, as I mentioned, a lot of markets are closed. We've got no trade in South Korea, Taiwan or Vietnam, so a lot of the action in tech stocks, well, your guess is as good as mine. Our best indicator is the Hang Seng Tech Index, currently off by 1/3 of 1%, the broader index better by 1/3 of 1%. However, Hong Kong's going to be knocking off early today. Everyone will go home in about an hour's time because it is, of course, the eve of Lunar New Year. Some of the other assets on the board there, we've got gold back below 5,000 an ounce. It initially popped above that level because we did get CPI numbers out of the US coming in a bit cooler than expected, 0.17%. We did see short end treasuries rally, tracking those CPI numbers lower, so it throws up some interesting conversations to be had around the direction of travel for the Fed this year as well. Crude prices picking up a little now, slightly in the green. We did see oil come off the back of a weekly loss. President Trump saying on Friday that regime change would be the best outcome for Iran. Negotiations will resume in Geneva this week. The president saying they could go on for a month. Well, the US Secretary of State Marco Rubio says his country is probably the only one able to bring Russia and Ukraine to the negotiating table. In an exclusive interview on the sidelines of the Munich Security Conference, we asked Rubio who he thinks is winning the war and how it can be ended.
I think that's a difficult war to say anyone is winning. The Russians are losing 7,000 to 8,000 soldiers a week. Yeah, not wounded, dead. Ukraine has suffered extraordinary damage, including, overnight, and again, to its energy infrastructure, and it will take billions of dollars and years to rebuild that country. So I don't think anyone can claim to be winning it. I think that both sides are suffering tremendous damage, and we'd like to see the war come to an end. It's a senseless war. In our view, the president believes that very deeply. He believes the war would have never happened had he been president at the time. So we're doing two things. So obviously we continue. Look, we don't provide arms to Russia. We provide arms to Ukraine. We don't sanction Ukraine. We sanction Russia. But at the same time, we find ourselves in a unique position of serving as probably the only nation on earth that can bring the two sides to discuss the potential for ending this war on negotiated terms. And it's an obligation we won't walk away from, because we think it's a very unique one to have. It may not come to fruition, unfortunately. I hope it does, and I think there are days when I feel more optimistic about it than others. But we're going to keep trying, because that is, in the end, this war will not be solved militarily. It will be, in the end, it will come to a negotiated settlement. We'd like to see that happen as soon as possible.
Do you worry that if Ukraine loses the war, it's going to be a disaster for the transatlantic relationship? Because Americans will say the Europeans didn't provide enough arms, and Europeans will look and remember the meeting in the White House and Zelensky and Trump, and they will blame the other way.
That would ignore reality. Look, Ukraine, first of all, they deserve a lot of credit. They fought very bravely. They've received extraordinary amount of support from the United States to the tune of billions of dollars that pre-exist the war. In fact, Ukraine probably wouldn't have survived the early days of the war had it not been for American aid that came to them even before the war had started. With the Javelin missiles that disabled the tank formations. I wasn't
saying it was fair. I was just saying there's a possibility. You have to deal with perceptions.
No, but I'm not worried about that, because I can tell you that I think history will understand it. But I don't think the war is going to end in a traditional loss in the way people think. I don't think it's possible for Russia to even achieve whatever initial objectives they had at the beginning of this war. I think now it's largely narrowed down to their desire to take 20% of Donetsk that they don't currently possess. And that's hard. It's a hard concession for Ukraine to make for obvious reasons, both from a tactical standpoint and also from a political one. And so that's kind of where this thing is narrowed. And, we'll continue to search for ways to see if there's a solution to that unique problem that's acceptable to Ukraine and that Russia will also accept.
The very common theme of your speech was the need to share the burden, the need for Europe and America to do things together, which was slightly different from the Vice President last year. Were you kind of offering a carrot where perhaps he was offering a stick?
I think it's the same message. I think what the Vice President said last year very clearly was that Europe had made a series of decisions internally that were threatening to the alliance and ultimately to themselves, not because we hate Europe or we don't like Europeans, but because what is it that we fight for? What is it that binds us together? And ultimately, it's the fact that we are both heirs to the same civilization, and it's a great civilization, and it's one we should be proud of. It's one that's contributed extraordinarily to the world, and it's one, frankly, upon which America is built. From our language to our system of government to our laws to the food we eat to the name of our cities and towns, all of it deeply linked to this Western civilization and culture that we should be proud of, and it's worth defending. And ultimately, that's the point. The point is that people don't fight and die for abstract ideas. They are willing to fight and defend who they are and what matters and is important to them. And that was the foundation he laid last year in his speech, and we add on into this year to explain to people that when we come off as urgent or even critical about decisions that Europe has failed to make or made, it is because we care. It is because we understand that ultimately our own fate will be intertwined with what happens with Europe. We want Europe to survive. We want Europe to prosper because we're interconnected in so many different ways, and because our alliance is so critical. But it has to be an alliance of allies that are capable and willing to fight for who they are and what's important.
Do you see a parallel? You seem to see a parallel between the Cold War, which I think I would argue that America beat the Soviet Union because it had a common idea and it had allies on its side. You're now in a struggle with China. As people say, you've often been a hawk on that subject. You're in a struggle with China. Do you think you absolutely need Europe to be able to
I would say two things. The first, the mentions of the Cold War to remind people of everything we've achieved together in the past, in times when there was doubt. I mean, it's hard to imagine today, but there were those who believed in the 60s and 70s even that at a minimum we had reached a stalemate, and worse, that perhaps Soviet expansion was inevitable and that we needed to come to accept it. There were voices that actually argued this. And so it's reminding people of what we've done together in the past, but it's also a reminder that at the end of that era, when we won the Cold War, there was this euphoria that led us to make some terrible decisions that have now left us vulnerable. It deindustrialized the West. It left us increasingly dependent on others, including China, for our critical supplies, and that needs to be reversed in order to safeguard us. And so I do think, yes, it would be ideal to have a Western supply chain that is free from extortion from anyone. Leave aside China, anybody else. We should never have to. We should never be in a situation where our alliance and our respective countries are vulnerable to extortion or blackmail because someone controls 99% of something that's critical to national life. So I think we do have a vested interest in that regard. Today is different than yesterday, but it has parallels, not in that China's the new Soviet Union, but that in our future, collectively, we'll be stronger if we work on these things together.
Various sort of allies. Mark Carney has just been to Beijing. Starmer has just been to Beijing. Merz is about to go there. Do you worry that they're beginning to drift off too much in that direction?
So we expect nation states to interact with one another. In the end, we expect nation states to act in their national interest. I don't think that is that in no way runs counter to our desire to work together on things that we share in common or threats we face in common. But I don't think visiting Beijing or meeting with the Chinese is on the contrary. I think it would be irresponsible for great powers not to have relationships and talk through things, and to the extent possible, avoid unnecessary conflict.
It's US Secretary of State Marco Rubio there, speaking exclusively with Bloomberg News Editor-in-Chief John Micklethwait in Munich. Right, let's take a look at Indian markets. We are just ahead of the open, about 6.5 minutes away or so. We are looking at some modest declines right now. The Sensex off by about 1/5%. We do have an AI summit getting underway in India today. Hotel prices are very expensive, as we were discussing towards the end of last week. Jensen Huang's not going to be there, though, due to unforeseen circumstances. We are waiting on some data out of India today as well. Wholesale prices, inflation for January going to be due out in a few hours' time. Also exports and imports for January as well. So we'll get you across the open in 6 minutes' time. Now we're also focusing on the implications of a big regulatory change in Indian markets. The RBI is tightening rules on loans taken by firms that pursue proprietary trading and offer leverage to clients in the latest bid to rein in speculative trading. So let's get some more details with Asia Equities reporter Ashutosh Joshi. So Ashutosh, tell us more about these new rules.
Hi, thanks for having me on the show. The new regulations from RBI are basically aimed at tightening rules for a flow of credit from banks to securities businesses, including proprietary trading as well as brokerages, is a bit of surprise and also comes at a time when Indian markets are struggling a little. We have seen start of the year hasn't been great for Indian equities. A number of issues have continued to drag down the appetite for global investors, even though in recent weeks there was some positive development that was on account of the trade deal with US. The RBI's latest rules basically aimed to tackle flow of funding towards brokerages and proprietary trading firms, as well as what that means is the cost for this funding will have to go up. That can be challenging for some of the companies, and they will have to source for alternative ways of funding, such as debentures or money market, but that means higher cost and a sort of dent on their overall profitability.
Ashutosh, as you're speaking there, we are seeing shares of some of these companies like Angel One, BSE also already declining in the pre-market here. What kind of impact can we expect to see on volumes as a result of these new regulations?
Some of the companies, especially the large brokerages, which have a significant MTF book, that is margin trading facility, they might have to tweak their strategy. It can be a short-term impact for some of these companies, since they will go back to exploring changes to the way they have offered services to their large clients. That is why we are seeing impact on some of the brokerages names, but analysts are hopeful that over a period of time this change will take place, and companies should be able to overcome the challenges. Point to be noted here is that the margin trading facility book in India has reached 1 trillion rupees or $12 billion around, which is a huge size. But again, if compared in a global context, it's not even 1% of the country's overall market capitalization. So to say this is an alarming growth would be unfair. But at the same time, the RBI has made it very clear that they want rules related to this credit flow to be more tightened, and brokerages to take up extra cost if needed.
All right, Bloomberg Asia equities reporter Ashutosh Joshi there, thank you. Still to come, we'll check in on India's IT sector as it navigates AI disruption. Anand, Rathi's head of mutual funds, Shweta Rajani, is going to join us with her risk assessment next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Ta-da! Some good-looking trophy. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back. You're watching Insights. Let's check in on how the India market's tracking. Been up and running for about 90 seconds now. We are keeping an eye on some of these brokerages. I'll get to that in a moment. But we've got the Sensex broadly flat at the moment, just off by a few points. The Nifty Bank Index off by about 0.25%. Some of those software names that we were tracking last week that got beaten up so badly are continuing to get beaten up today. We've got TCS and Wipro off by a little bit more than 2% each. Of course, we do have that AI summit due to get underway in India today as well. Jensen Huang will not be in attendance due to unforeseen circumstances. The Indian rupee also looking somewhat calm at the moment. Now, let's take a look at those brokerages. BSE off by 9.7% at the moment. Angel One, that's off by 7.6%. And this is on the news that the RBI is moving to crack down on some of the behavior of these brokerages, particularly in terms of offering leveraged lending to some of its customers. So those stocks are getting hit pretty hard in the early going at the moment. All right, joining us now is Shweta Rajani, head of mutual funds at Anand Rathi Wealth. Shweta, I do want to start with that sell down that we've seen for some of India's software stocks. I mean, they are declining again today. Do you feel that this is justified, and where's the floor?
Good morning, Paul. So basically, I'm going to break it down into two parts. If you see the earnings season for the IT companies have not been so great, but they've not been so bad. I would say it's a modest growth YOY. They've been reporting 8% revenue growth and a 7% PAT growth. So given the environment, I would say that's a decent number. But clearly, there was a slight overvaluation. And then given the news that we're hearing beginning of this month on the entire AI disruption has led to some dent in the sentiment, and due to which we are also seeing a fall. I would say there could be some more short-term pain that we may see over here, but roughly what you should expect is, in our view, not big bang double-digit numbers over here, but a modest single-digit growth numbers over a medium term can be expected from these companies for sure.
Thanks, man. Yeah, even after the sell down, we still do have these companies trading, at a pretty healthy premium when you consider forward earnings. Is there some way to go before you feel like investors might be ready to step back in?
Yes, that could be. So if I'm looking at it from a PE perspective, the long-term average would be at around a 20 PE. The companies are trading at, from an index perspective, at a 22 average PE. So given that you are growing at a pace which may continue to be at around 7-8% of PAT growth for the next 1 year, there could be a slight valuation correction that we may see, given that it's also coupled with sentiments being weak at this point of time, and then you see that uptick coming in. Also, the previous 2 years, if I look at the calendar year 23 and 24, the sectors reported 15-20% growth in the prices. So given that upside, a little bit of mean reversion coming in 25 and now 26, somewhere kind of justifies that higher valuation premium.
Yeah, we've seen Infosys and HCL sort of nudging up their guidance a little bit, but the stocks are still getting hit pretty hard. Do you feel like there's maybe a disconnect here between the optimism of management and the reality of the deal pipeline and the narrative around AI?
Yeah, so we have seen that they are upping the guidance a little, but what we are actually seeing at, in terms of the convergence between the guidance and the actual numbers and the overall, the order book and the way their valuations are today, I wouldn't expect too much of an optimism coming in over there. Yeah, you're right. I think the management's being more optimistic than where we are seeing, considering the environment is also very dynamic at this point of time. And if you look at it, some of these large cap names are struggling a little, but the mid cap IT still looks a little better than the large cap names that we are seeing in terms of their adaptability and the order book that they would have.
More broadly, we seem to have this dual narrative going on, don't we? That, on the one hand, AI could destroy absolutely every industry that it touches, and then on the other, this concern that some of those hyperscalers are indulging in capex that's going to take quite a long time to see a return on. Do you feel like it's possible to hold those two fears in your head at the same time, or is there a disconnect there?
Sure. So, the entire AI bit, which could have some amount of an implication on employment and the way the companies are operating today is true, but how do you actually transition from that entire space would be a few years away. And I'm sure by that time, companies would also adapt to see what's the best in terms of maintaining a balance between the valuations at which they're trading, the profits or the business expansion that they could have. So CAPEX would also be needed in terms of doing this shift. The entire bit of migrating today, ensuring data security is very critical over the next few years. So we have to wait and see how it goes. The transition period, of course, can be a little volatile for various sectors, but I would look at it that it would have more positives than negatives because of this entire transition.
In terms of the negative, do you think it's a realistic fear that some of these AI agents are going to, really eat the lunch of those IT firms that, traditionally bill for software services?
Yes, to a certain extent, it could have an implication. But if I'm just focusing on the Indian IT companies, where the role that they play clearly is very good, going to be very important, because you have your AI tools, but how do you migrate and ensure that the entire transition is happening in a well-governed, secured manner is where the IT services, the IT companies would play a very critical role. Also, what's important to see is how much of the research and CAPEX is going towards building that research on your AI and stepping up in terms of what's really happening. The environment right now is so dynamic that you have to be ahead of the curve. So if you are spending in that right direction and your the revenue stream is coming in from that service space, I guess those companies would do better. So it's going to be not that everything would do well or everything would suffer at this point of time. It's going to be very company specific. So coming back from an India perspective, I think the Indian mid-cap IT companies are far more adoptive, are far more in this space where they would profit more than the larger cap companies that we have at this point of time. So it's going to be very company specific of how you see.
Yeah, well, certainly some of the risk-off sentiment around these Indian AI names seems to be abating today. I mean, we have Tata Consultancy and Wipro both narrowly in the green at the moment, so perhaps the selling's over. But maybe the focus has shifted now to some of these brokerages firms in terms of the new regulations from the RBI looking at cracking down on speculation. Do you have a sense that some of these firms like Angel One, BSE are going to be in the firing line, not just today, but possibly for the rest of the week?
Yes, Paul, that is very much a possibility because there would be a sentimental impact that would come in even on those companies. And clearly, RBI has been working on bringing in more governance and seeing what is right for the investor. So, all the actions that they've been taken over the last one and a half year, whether on, the margin fundings, MTF, limits, all of that would have some implication here. So we could see maybe a week of some more dent over here, very company specific again in the financial services and brokerages segment. But net, I think if I'm looking at it from a 1 year perspective, there's still a huge potential in the segment.
All right, Shweta, thanks so much for your insights today. That is Shweta Rajani, head of mutual funds at Anand Rathi Wealth. Still to come, Barclays Mitul Kotecha is going to break down its bank's latest report on Asia's blazing start to the year. EM assets rallying, the dollar slipping, and reflation risks rising as commodities surge. He'll tell us which markets could win next. This is Bloomberg.
The Vice President said last year very clearly was that Europe had made a series of decisions internally that were threatening to the alliance and ultimately to themselves, not because we hate Europe or we don't like Europeans, but because what is it that we fight for? What is it that binds us together? And ultimately it's the fact that we are both heirs to the same civilization, and it's a great civilization, and it's one we should be proud of. It's one that's contributed extraordinarily to the world, and it's one, frankly, upon which America is built.
Welcome back. You're still watching Insight, and that was US Secretary of State Marco Rubio speaking exclusively to Bloomberg Editor-in-Chief John Micklethwait. They were there at the Munich Security Conference. Now, Rubio also downplayed the chances of a fracture in the US and European alliance if Ukraine loses the war with Russia.
The Russians are losing 7,000 to 8,000 soldiers a week. Not wounded, dead. Ukraine has suffered extraordinary damage, including, overnight, and again, to its energy infrastructure, and it will take billions of dollars and years to rebuild that country. So I don't think anyone can claim to be winning it. I think that both sides are suffering tremendous damage, and we'd like to see the war come to an end. It's a senseless war. In our view, the president believes that very deeply. He believes the war would have never happened had he been president at the time. So we're doing two things. So obviously we continue. Look, we don't provide arms to Russia. We provide arms to Ukraine. We don't sanction Ukraine. We sanction Russia. But at the same time, we find ourselves in a unique position of serving as probably the only nation on earth that can bring the two sides to discuss the potential for ending this war on negotiated terms. And it's an obligation we won't walk away from, because we think it's a very unique one to have. It may not come to fruition, unfortunately. I hope it does, and I think there are days when I feel more optimistic about it than others. But we're going to keep trying, because that is, in the end, this war will not be solved militarily. It will be, in the end, it will come to a negotiated settlement. We'd like to see that happen as soon as possible.
Do you worry that if Ukraine loses the war, it's going to be a disaster for the transatlantic relationship? Because Americans will say the Europeans didn't provide enough arms, and Europeans will look and remember the meeting in the White House and Zelensky and Trump, and they will blame the other way.
That would ignore reality. Look, Ukraine, first of all, they deserve a lot of credit. They fought very bravely. They've received extraordinary amount of support from the United States to the tune of billions of dollars that pre-exist the war. In fact, Ukraine probably wouldn't have survived the early days of the war had it not been for American aid that came to them even before the war had started, with the Javelin missiles that disabled the tank formations.
I wasn't saying it was fair. I was just saying there's a possibility. You have to deal with perceptions.
No, but I'm not worried about that, because I can tell you that I think history will understand that. But I don't think the war is going to end in a traditional loss in the way people think.
That's US Secretary of State Marco Rubio speaking exclusively with Bloomberg News Editor-in-Chief John Micklethwait in Munich. In other news, hundreds of Malaysians rallied in Kuala Lumpur on Sunday, demanding the arrest of anti-graft chief Azam Baki over alleged improper shareholdings and abuse of power. Let's bring in Bloomberg's chief Asia correspondent Rosalind Matheson for more. So, Ros, we had a lot of protests over the weekend. What are they accusing of Azam of, and is there any evidence?
Well, that's right. As you were saying, we saw hundreds. Some estimates are about 1,000 people come out on the weekend. This is not the first protest that's happened, though, against Malaysia's anti-graft chief. There were also protests back in 2022, also over allegations around his shareholdings. And the idea that the reports are basically that he invested in a company over the value of what he was allowed to as a public servant. And also, did he declare that holding in the way that he should? And now there's an investigation into that's going on at a cabinet level. Obviously, Azam has replied to say he has nothing to hide. He welcomes the investigation. He says he's done nothing wrong. But the questions that linger over this agency, this is the agency that polices everybody else, and whether it now needs policing itself. I mean, this is a leader, an agency who has been kept in his position, even though he's over ostensibly the retirement age. So the Prime Minister has extended his tenure several times. It's up again in May this year. Is that a moment when he gets extended again, or does another leader of this agency step in? But more broadly, again, it raises those questions for business and investors in Malaysia. Graft is still seen as widespread in the country. The Prime Minister came to power vowing to finally tackle it. There is evidence that that's not really happened. And so for businesses wanting certainty, they're watching this case very closely to know, is the anti-graft agency truly doing its job?
Yeah, well, let's talk about what's going on in Indonesia as well, because the Indonesian President Prabowo reacted, well, let's say poorly to the sell-off that we saw in Indonesian stocks towards the end of last month. What do you have to say, and is the country doing anything about MSCI's requests?
Well, that's right. So our reporting from Bloomberg shows that Prabowo was quite angry when the market sell-down was going on, that he summoned officials to his residence, which is outside Jakarta, and demanded to know what was going on. He's been trying to clip the wings of some of the tycoons in the country. He was saying, was it their fault this was happening? He was told, no, the regulators have not responded to the concerns from MSCI, which were there for quite a long time around a lack of liquidity, for example, in the Indonesian stock market. So then he demanded that those officials be fired. But the story more broadly points to this idea of a leader who, I guess, unsurprisingly operates with a very small inner circle. People are not willing to question his policies and reinforce his thoughts about economic policy in the country, and whether others are able to get access to him, a sense that he's quite elusive as a leader, and whether he's hearing concerns around the broader path forward for Indonesia that this stock market meltdown showed investors. Broader questions around his policies about investability in Indonesia, and whether his budgetary policies are going to bear fruit, and whether he's willing to change course. The sense from our reporting is that he believes this was a short-term market meltdown. He doesn't see the need to change his policies, but investors are starting to say otherwise.
All right, Bloomberg's chief Asia correspondent Rosalind Matheson there in Singapore. India's AI Impact Summit begins today, bringing together global tech leaders, policymakers and innovators. The event aims to position India as a key AI player, with participation from more than 100 countries, and guests include Google CEO Sundar Pichai, OpenAI's Sam Altman and French President Emmanuel Macron. Let's get to Bloomberg India government reporter Sudhi Ranjan Sen now. So, Sudhi, let's focus on the world leaders that are coming in for this. Macron is arriving just as India announced that massive deal for Rafale jets. What else is he hoping to achieve?
Well, I mean, it's, through the Rafale deal, what we can see is that India is diversifying its source of military equipment. Mind you, India is the second largest importer of military defense equipment, and so long it's been dependent on Russia. It continues to be dependent on Russia, although the share of Russian military hardware coming to India has been falling, and this is what the Stockholm International International Peace Research Institute, which tracks global, arms sales, independent non-profit think tank, has been putting out in its report. It's very interesting to see that India is one of the biggest buyers of French military hardware, and over the years that portion is going up. That is one part of it. India and France also have a very deep cooperation on the nuclear side, in space, and also, as we have seen from the last AI summits, there is a growing alliance between the two countries on what to do with AI governance. Mind you, both countries, India has lost out on the AI race, so have the others. The AI race, so to say, is dominated by conversations between the US and China. So it is countries like India and France are getting together with the idea to have some kind of a stake, and with other countries who are in a similar situation, to kind of dictate or kind of have a say in how the governance of AI happens. So that is what basically the summit is about. On the sidelines, of course, we are going to see India and France coming together even closer.
So who are the other world leaders that are expected to attend, and what does Prime Minister Modi hope to gain from this summit?
So there are about 20 world leaders from the last briefing of the government in India. What we know that about 17 are already confirmed, and these are smaller European countries. There's countries from Asia. There are countries, and there are delegations from across the world. Several big CEOs of AI companies also expected in India who've confirmed their attendance here. What India hopes to achieve broadly is to be the voice of people who are going to get affected most by the AI, because AI is, and therefore, if the way the summit has been laid out, it is on impact, it's on governance, it is on responsible use of AI. These are the issues that are being discussed, and the joint statement that we expect, it's under negotiation already, and on Saturday the senior government officials told us it's nearly there. The joint statement is nearly there. So we are going to see some kind of a statement which talks about how to use AI in a responsible manner. Now, the big question that arises is, will this be enough, either for the US or China, which is leading the AI race? Will these countries be able to prevail upon them to listen as to what these countries have to say? That will be the big question in the coming days.
All right, Bloomberg India government reporter Sudhi Ranjan Sen there. Still to come on Insight, emerging market currencies are proving more stable than those in developed nations. We discuss the outlook for currencies with Barclays Mitul Kotecha next. This is Bloomberg. Emerging market currencies are proving more stable than those in developed nations, a streak some investors say could become the longest in more than 2 decades. Let's get more now with our executive editor of Asia Markets, Paul Dobson. So, Paul, what's driving this phenomenon?
Yeah, hi there, Paul. So this number crunch that my colleague Marcus Wang has been doing has found that we're almost 200 days now where volatility for emerging market currencies has been below that of developed market currencies, which is, as you said, close to the record and not what we're normally used to. Normally you would expect emerging market currencies to swing around more wildly, to be less liquid, to be more prone to shocks. But right now, at this moment in time, they're actually proving stable, and there are a few things there. One of them is that the governments in general are looking relatively strong at the moment. You've got a weaker dollar in general supporting emerging market currencies, and you've also got that sort of subdued volatility helping the carry trade, which has seen large amounts of money pouring in. On top of that, I think in general you've just got emerging market outperformance across the equity space as well relative to US markets, which is making them look much more attractive. It doesn't take a lot of money coming out of the US market and going into emerging markets for them to outperform quite strongly. And so we're seeing that pick up across asset classes and reflected in the currency markets, which are steadily appreciating in the start of this year and over the back end of last year as well.
Of course, I guess we can't generalise, though. I mean, we're still looking at a very weak rupee. The rupee has taken an awful beating, and then on the other hand, we've got a very, very strong Thai baht. So what are the idiosyncratic stories here, and is there a political dimension to it?
Yeah, there's always that risk. But I think that another thing that is helping to a certain extent is you mentioned both India and Indonesia. Right, they have come under pressure. They are close to record lows, but they're not crumbling exactly. And part of the reason for that is that the central banks in those nations are stabilizing markets, are leaning in against the weakness and preventing the moves from becoming too aggressive or too rapid. And I think that, the reason that they can do that is because they have pretty decently strong reserves at the moment, so they have firepower to resist a market drawdown. So for those currencies under pressure, the central banks or the authorities are able to support it in a way that perhaps 10 years ago, 20 years ago wouldn't have necessarily been the case quite the same. But you're right, there are idiosyncrasies within all of this. It's not all about gains. Some of the strong performance we see come from the commodity space, the Latin American currencies. Some of Southeast Asia's markets are under pressure, some of Southern Asia, some of them are performing quite strongly. I think in our region, another anchor is that yuan appreciation in the Chinese market, just very slow, gradual progress against the US dollar, which kind of brings a lot of the rest of the region's currencies in its wake, is going to continue as a sort of trend. And that not only subdues volatility, but also offers some support.
All right, Executive Editor for Asia Markets there, Paul Dobson. Well, let's get market insights now from Mitul Kotecha, Head of FX and EM Macro Strategy Asia at Barclays. Mitul, thanks so much for joining us and just picking up on those observations that Paul was making there. Do you see this trend for emerging market currencies enduring, or are there some factors here that could bring about a reversal?
Well, I think the trend probably will endure. Our view is that EM is an underinvested asset class more broadly, and we could see in an environment of weaker dollar, especially as we believe this dollar risk premium is rising amid increased hedging and potential diversification from US assets, it really does bode well for an underinvested asset class in particular. So not only is broad EM going to benefit, and we're seeing inflows coming through into local currency bond markets, into equity markets in EM, and at the same time we will see EM benefit from its high carry in some areas. So, for example, Latin American currencies offer generally good carry, and one of our favorite trades has been a long high carry basket versus low carry, and I think that's something that's going to continue to play out. Now, as you were talking about earlier, volatility in EM currencies is at super low levels. We think China continues to be a volatility killer as well, given its steady approach to maintaining that sort of marginal gradual currency appreciation. So I think it does bode well, and overall we expect that to endure.
Okay, so the momentum's heading in this direction. Is there a chance that this becomes a more permanent structural shift?
I think that's a difficult one. I think EM still has some structural headwinds. Look, I think at the same time, we can't ignore the fact that the US is still investing massively in its AI infrastructure. I know there are doubts about the spending and the returns on such investment, and in particular impacts on AI services. But we still see the US as a leader in this field, and that could potentially generate increased US productivity. Certainly, the investment will generate increased and stronger US growth. So we wouldn't necessarily rule the dollar or US assets out in this environment. So look, while AI or EM is benefiting for now, and we think that could have some legs on it and continue in the next several months, whether this continues on a structural longer term trend is still to be seen. I think to your point earlier, when you look at Asia, fundamentals have definitely improved. Current account, fiscal balances, FX reserves, general resilience of policymaking is far stronger. So I think that's going to also be helpful, not just in Asia, but perhaps in a lot of EMs as well.
Yeah, I think we're seeing the fastest pace of EM inflows now since 2019. Is there a risk that this trade gets overcrowded at current valuations?
Probably not at least for now. I think if it continues at this pace, yes, we'll see flows back or revert to trend. But when we've looked at trend inflows into EM assets and looked back at previous years, we're still well below that trend. So we could still see a substantial inflow back into EM. And we've already, as you said, seen a very, very sharp flow at the start of this year. It's hard to see that turn around anytime soon. And I think given some of the uncertainty around US policymaking, US assets in general, it does certainly bode well for those EMs with strong fundamentals and in this environment, high carry. I think the only caveat I would say for Asia, Asia generally is a low carry region. So it's not going to be a big beneficiary from a carry trade hunting environment. You mentioned a lot of idiosyncratic factors, and a number of Asian countries do have some idiosyncratic factors that could still weigh on them. I was in India last week, and our view is the rupee could still underperform despite the trade deal, for example. So, we've got to be careful about not painting everything with the same brush.
Well, let's look at some of those more stable EM currencies like the Singaporean dollar, the Thai baht, the Chinese renminbi as well. Within your EM macro strategy, are these almost looking like developed market currency havens?
Well, they are. And as I mentioned, I think the fact that you've got such a fundamental improvement in the region. Look, I hark back all the way to 97, 98. I was in London as an FX strategist. I looked at Asia then, and you looked at massive fiscal imbalances, current account imbalances, currencies that were overvalued and pegged to the dollar and high rates. And now you turn to the other side of the pond, and it's not Asia that looks like that, but perhaps more so the US. So, look, clearly things have changed dramatically, and the fundamental picture has improved. And as you said, there are some currencies. Sing dollar is obviously seen as a very significant safe haven for Asia. That's why the Singapore dollar, Sing Nia, is trading very close to the top end of its band at the moment. So, I think, again, I don't see that turning around very quickly.
Well, you mentioned these low carry currencies. The yen, obviously, a very high carry currency. Some have described that as a ticking time bomb. I mean, if we saw a disorderly unwind in Japan, could these EM currencies survive the contagion?
Well, I think if there is a massive unwind of Japanese foreign invested assets, I don't think many countries or many assets would survive in a large way. But at the same time, I think we've already seen a significant unwind from Japanese investors. There's also a significant amount of these NISA tax-efficient outflows from retail Japanese investors. And at the same time, I don't think that it's in the interest of Japan to have a massively strong currency. So I'd imagine there'll be resistance not only to yen weakness, but to extreme yen strength as well. So, but for now, in the near term, we would see dollar yen being supported around this 150 level. And look, I think, that Takaichi trade, which had been weak yen, the sell-off in long-term JGB rates has effectively turned over quite quickly. Xi no longer, or the LDP no longer needs to support the opposition. Therefore, they can implement policy a little bit more in a measured way. Bank of Japan can continue to tighten policy. We expect that next hike to be in April. So again, I don't necessarily think we're going to see a big unwind of yen assets in this environment. And actually, the yen isn't necessarily the best safe haven in this environment. It hasn't really acted as a safe haven for some time. The likes of the Swiss franc, for instance, in major currencies is doing a better job as a safe haven currency.
Well, the market's obviously pricing in gradual Fed easing going forwards from here. But if it doesn't happen for whatever reason, and it didn't really happen in 2025 to the degree that the market expected, could this EM trade turn around?
Look, I think the Fed is only going to ease gradually in our view anyway. We think June and December, with the risk of actually later than earlier easing from the Fed. Now, I think last week, for instance, we saw a mixed slate of data. We had retail sales coming in soft, but at the same time, payroll strong, CPI slightly soft. But the momentum, we still think, of the US economy continues to remain firm. As long as the Fed only eases gradually and continues to ease, that'll be beneficial. But look, I don't think EM is necessarily relying on Fed rates or Fed rate cuts to spur these inflows. This is a diversification flow. This is an asset allocation shift in some ways, where incremental flows into new assets are moving towards EM to a large extent. So I think, even if the Fed doesn't cut or delays easing, I don't think it significantly changes the picture for EM assets.
All right, Mitul Kotecha, Head of FX and EM Macro Strategy Asia at Barclays. Thanks as always for joining us. Still to come, India rolls out new rules to lure private money back into highway building. And with $11 billion in projects up for grabs, the race is on to ramp up private investment. We'll have details of that story up next. This is Bloomberg. Welcome back. You're watching Insights. Let's take a look at how Indian markets are tracking at the moment. We have a little bit of softness for some of these brokerages names at the moment following a change in rules from the RBI, particularly around leverage when it comes to offering leverage to customers. We've got the Sensex better, though, by about 1/10%. The sell-off that we saw in some of those software names seems to have abated somewhat. We've got the rupee still fairly weak, 90.69 versus the US dollar. Got some breaking news out of Japan as well. We've got industrial production numbers for the month of December coming in with a contraction of 0.1%, follows the similar contraction that we saw in the month prior. And these, of course, come off the back of GDP numbers in Japan earlier today, which were somewhat anemic. Consumption data in particular was somewhat weak. We've got industrial production there you see on your screen at 2.6% growth on year. Well, India is working to lure private capital back into highway construction, and this comes a decade after investors retreated over concerns about revenue risks and bureaucratic delays. Let's get to our India infrastructure reporter now, Mihir Mishra. So, Mihir, how has India's infrastructure build-out been so far?
So India has been building infrastructure across sectors. For instance, they have been building new airports as well as building new ports, and also has been building infrastructure. So the infrastructure build-up by India has been all across to ensure that the primary concern is to reduce the logistic cost, which is the biggest complaint of the industry as India tries to attract more and more private sector investment into the country. The second is to improve connectivity, and the third in the port sector is to provide some sort of a capacity for companies that are planning to build manufacturing here in India to be able to export the goods that they manufacture in India. So the build-up has been all across, and private money is key to ensure that this build-up continues to happen.
So what's India's experience so far with private capital when it comes to these key infrastructure projects?
So if you look at sectors like aviation, where there has been a fair amount of private capital being utilized and being used to build airports, there have been fair amount of private capital being invested in port sector as well, and it continues to happen in both aviation as well as port sector. But the highway sector has been a laggard in that sense. In the past decade, India has not seen much of an interest from private capital in the highway sector. Now, the key reasons for it are a lot of competing infrastructure coming up, plus there are bureaucratic delays in getting approvals for road projects, plus the issue of, and all these tend to make these projects unviable, and which is why the private sector has kind of stayed away from highway sector. So it's a mix. While ports and aviation have seen good interest, phenomenal interest from private capital, roads roads is one sector where the private capital has stayed away from. Now, in India, with these initiatives, essentially, is trying to bring that capital back into the road sector.
So what's India looking for when it comes to these reforms in the highway sector?
So they have had an extensive consultation with the private industry, trying to understand the problems that they have and the reasons why they're staying away from the highway sector. So 2-3 key things came out of it. One is, of course, the delays in approvals that are essentially to ensure that road projects are built on time and they start making money for the private company. The second, of course, has been The second, of course, has been the interest from, and what it does is that once the projects turn unviable, the banks are not willing to lend for these projects. So essentially, it becomes very difficult for a private company to kind of go ahead and implement a highway sector project, which is why we have seen India focusing more on building highway projects through public money, through one form or the other, but essentially it is being built through public money. Now India has a huge plan. They have been building highways all these years. Now they want to build expressways essentially and high-speed roads. And the plan is to build at least worth of $125 billion of highway projects over a period, within a decade. And so the plan is to try and get more and more private capital for these high-speed road projects, which are very much capital. They require a lot more capital than building a normal highway projects. That is the long-term plan that India has, and the short-term plan is to, which is for the next financial year, is to kind of fund these highway projects worth $11 billion from private money. Essentially, the focus is of the Indian government is to move away from funding these projects to bring in as much private capital investments into the highway projects to ensure there are two benefits of it. One, a private sector investor would try and build the project faster, so that brings in efficiency in the system, and it leaves the Indian government some more money for other requirements that they have. So essentially, the target is to get as much private capital as possible in the road sector.
All right, Bloomberg India infrastructure reporter Mihir Mishra there. Still to come, how a slump in Bitcoin below $60,000 could unleash a fresh wave of market chaos. More on what's fueling the crypto jitters next. This is Bloomberg. Welcome back. You're watching Insights. Hong Kong and mainland Chinese markets just closed for the New Year holidays, but a worsening earnings picture is clouding the outlook for equities there, and this has left investors wary that this week's holiday spending may not be enough to reignite a rally. Let's get to Asia equities reporter Sangmi Cha. So, Sangmi, what are we expecting out of the Lunar New Year holiday?
Yes, this is normally a time when we're talking about better consumptions and exciting consumer trends, but we're seeing actually a tech sell-off that comes from Friday when Pentagon actually uploaded a list of some of the companies that would be added to this list and of course it doesn't have this legal binding, but still Washington has been increasingly using this list to work as a warning for the U.S. investors that invest in these stocks. We are looking at Alibaba stock. It fell. BYD, the EV maker, and Baidu that were added and then immediately in a few minutes removed from the Pentagon list. So we'll be watching what happens after the market comes back. But today, definitely the focus has been on these stocks.
So where can investors still find opportunities in Chinese stocks despite weak consumer demand?
Right, so we've been seeing the earnings outlook quite cloudy for the fourth quarter, and we can see that in the earnings, negative earnings alerts that has been outnumbering the positive ones by about 15%. And that compared to the second quarter when the negative ones were about 4.8%, that's a huge deterioration. But there are definitely some opportunities here. Some of the mining names like CMOC, which was also added to the Hang Seng Index, have been gaining, and software makers, for instance, like iFlight Tech, has also said that they're going to have very nice earnings growth, about 40% to 70%. So there are places of opportunities here, but again, it's becoming very, very selective in Chinese stocks here.
All right, Bloomberg Asia equities reporter Sangmi Cha, thank you. All right, let's take a look at how cryptocurrencies are tracking at the moment. It's been a rough little while for crypto assets, Bitcoin included. We've got Bitcoin right now just above 68,000, 68,500. Solana losing a little bit of ground as well. We saw Coinbase I beg your pardon, missing earnings also. Benchmark analyst Mark Palmer cut his price target by 37% on Coinbase, but he's kept a buy rating on it. Okay, kind of underscores some of the confusion around crypto at the moment. Traders have got a new red line in sight for Bitcoin as well, and that is $60,000. Considered the key level to watch, as a cluster of options bets will pay off if the price falls below that level. Now, as you can see, Bitcoin's yo-yo price swings flirted with that level earlier this month before staging a modest recovery. Joining us now with more on this is Bobby Lee, founder and CEO of Ballet Crypto Storage. So, Bobby, I just want to start by seeing if you're able to explain or unpack the recent price action that we've seen in Bitcoin.
Yes, so Bitcoin, price is very volatile. A lot of it is due to trading, not just investment, but a lot of traders are trading it on the spot exchanges, on the derivatives, futures, and like you said, the options market and the futures market. So with a lot of longs and short position, it becomes a very volatile asset, especially now that we see the bull market is over. So we're in bear market territory. So there's got a lot of room to fall.
So where is the next support level for crypto, and what happens if we break through that? Is it 60,000 or are you watching another level?
I think you called it right. At the $60,000 level, there's going to be a lot of liquidations. You can see that it's very public in terms of where the long positions are at and their margin call support level. I think it's very likely in the next few weeks it'll breach below 60,000 and probably support level around 50, 55,000. And then for the rest of the year, it could go lower too.
You gave us one reason for this potential sell-off a moment ago. I'm wondering if I could offer another theory. I mean, at the same time that Bitcoin's losing ground, we have tremendous demand for GPUs from AI's hyperscalers. Now, if you're running a Bitcoin mining operation, isn't it very tempting to stop mining Bitcoin and rent out your processing and your energy and everything else to the AI picture?
Yes, but it's not a leading price influencer. So the amount of people who are mining Bitcoin, the amount of machines and hash power that's mining Bitcoin does not lead to the price. Rather, it's a lagging indicator. So a lower price will cause more miners to be unprofitable and they would leave the Bitcoin mining and maybe repurpose their machines to do something else, whether it's for AI data centers or anything else. So the relationship is the price dictates how many people, how many mining companies, how many machines get put in place to mine Bitcoin.
Do you feel like this is a crypto-specific plumbing issue in many ways? I mean, you mentioned before about some of the trading action that's been happening.
In terms of what? Sorry, I didn't get that question.
Do you feel that this is mainly a macro story, or do you feel like it's a more crypto-specific issue around the plumbing of the market that might be breaking down?
It's both. I think the Bitcoin, as we know, about 4 months ago, Bitcoin topped out at $126,000. This is in September timeframe, and then there was a crash in early October, but due to a liquidity crunch, we saw another crash about a week or two ago. So we're in bear market territory, and a lot of crypto and Bitcoin people are still in denial, still hoping for a bull run in the coming few months or rest of this year. But having seen this many times, several cycles in the last 15 years that I've been following Bitcoin, I think we're clearly in a bear market territory, and the long position holder is going to be in for some pain in the short term.
Is there a broader, bigger problem here as well? Because, you mentioned the 15 years. Well, it's been around for a while now, but we still don't have a single mainstream daily use case for this. It still seems to be a speculative asset where all you can do is buy it at one level and hope that someone else buys it off you at a higher level. Is that really it?
So I actually disagree that it's only for speculation. Its use case is really a store of value. To me, Bitcoin is actually, if you think about it, it's the world's only asset where there's a fixed, limited quantity that's truly decentralized, not controlled by any government, not controlled by any financial institution. So there's only forever going to be 21 million Bitcoins ever. And if you have, whether it's 1 Bitcoin or 0.1 Bitcoin, you have a fraction of the whole Bitcoin supply, and it's kind of like a store of value. It's no different than, for example, the global structure, IMF and banking. They have the SDRs, the special drawing rights. So in terms of fiat money, it continues to be printed. This is what leads to inflation and higher prices, whereas Bitcoin, it's a deflationary asset class. I think it's great for long-term investment. Of course, a lot of people are speculating on that, which is why there's all this trading, all this derivatives and futures. But thankfully, on the flip side, we have now ETFs for Bitcoin, allowing regular people to more easily buy and invest in Bitcoin. So I do think it's useful as a global reserve asset.
Have the events of the past month, though, punched a bit of a hole in that store of value argument? Because at exactly the time gold set new record highs, Bitcoin pretty much halved in value. Is it really a store of value?
It is. You get to think about it from a long-term perspective. And what I mean by that is, look at gold. Gold, crossed $5,000. But for many years, it was languishing in the, $800, $400, $1,000. And even at that point, when it was below $1,000, gold would go up and down a lot, very volatile. Probably not as volatile compared to Bitcoin, but the point is, it was still in a price discovery phase, right? So today, gold is $5,000. It could easily go to $10,000 in the next few years. Same with Bitcoin. Bitcoin today is $60,000, or it might go down to $50,000 or $40,000. But when it gets to $1 million, people will look back and say, "Oh wow, I really missed out." If you think about it, what's the difference buying Bitcoin at $60,000 versus $40,000 versus $100,000? When Bitcoin has $1 million, it's not really a big deal anymore. So it's really, for me, it's a long-term investment class.
But to my point, and I'm sorry to labor it, when crisis hits, the Bitcoin crowd seems to flee for the exits and go to those traditional safe havens.
It's not that the Bitcoin crowd flees. I think the traders are fleeing. A lot of the people who are dictating the day-to-day price movements are actually short-term traders trading on momentum with margin, whereas the long-term holders of Bitcoin, what we call the hodlers, they're staying put. Like myself, I'm staying put. So over the last few months, including the last few weeks, with the Bitcoin price dropping down, I'm not giving a sweat. There's no worry on my part. I'm still very strongly bullish on Bitcoin in the long term. I think for the short term, Bitcoin price will have some strong corrections.
But if you do hold forever, how do you ever make a profit? And when you do sell, you're back to holding fiat.
Well, it's no different than real estate. If you look at the very savvy real estate investors out there, they're holding real estate probably forever as well. Intergeneration real estate holdings in the U.S., a lot of 1031
but real
exchanges.
estate will pay you a return. Bitcoin won't.
That's true. But the paying return is first of all, it's fiat money. It depreciates over time, inflationary, and also you have property taxes, right? So real estate, yes, you have yield on it, but there's also property taxes and other things. And Bitcoin itself, if you hold Bitcoin either through ETF or other position, you could be selling calls on it and have sort of yield income as well.
So you remain bullish. What signals would you watch that suggest the capitulation is ending?
That's a great question. I think the answer, unfortunately, is that when no one's talking about it, when Bitcoin is left for dead, when no one's interviewing anyone to talk about Bitcoin, when Bitcoin is just left for dead, it's in the low, tens of thousands of dollars, up, down maybe 80% from the peak. And that's when we will see the market bottom. It might even be a sharp sort of red line drop into the $20,000, $25,000 range on a specific day later this year or next year.
So if that's possible, do you buy at that level, or are you buying now, or at what point do you buy?
So first of all, I have already made my commitment to invest in Bitcoin, so I already have a good position. Myself, I probably don't need to buy more. But for people who are still looking to get in on Bitcoin, the savvy thing is to buy low and sell high. And unfortunately, a lot of people know the idea of buy low, sell high, but they actually do the opposite. They actually buy Bitcoin when it's FOMO, fear of missing out, when the price is rising. And then when the prices are dropping like it is in the last few weeks and months, people get really scared and they actually sell. So the proper thing to do is accumulate maybe dollar cost averaging, DCA, over the next few months, over the next 2 years. So buy some when the price is good. Bitcoin is on sale right now.
I'm also curious whether you think maybe Bitcoin's lost a little bit of its allure among that crowd that was very excited at the time when it was launched, but perhaps that crowd has moved on to new things such as the prediction markets.
So the prediction markets is just a sort of different way of looking at sports betting. Obviously, it's not just sports. It's real life, politics, everything real world events. It's a broader market. It's more decentralized, a lot more players. So it's not limited offering by casinos only on certain sports games and so on. So the prediction market, I think, is a trend. But I think investing in Bitcoin is a separate thing. It's just like you could invest in art or you could invest in stocks, but just because stock prices go down doesn't mean that people are fleeing the stock market and going to art. I think these are distinct investment vehicles, and some people play in both and some people play in just a few.
All right, Bobby Lee, founder and CEO of Ballet Crypto Storage. Thanks so much for joining us today. Now, here are some of the other stories that we're watching. Warner Brothers Discovery is said to be considering reopening sale talks with Paramount Skydance. Our sources say Paramount submitted amended terms last week, trying to topple the existing deal with Netflix. The new offer includes Paramount covering a $2.8 billion fee owed to the streaming giant if Warner terminates their agreement. Warner had agreed to sell its namesake studio and HBO Max streaming business to Netflix in an all-share deal. Bloomberg has learned that Ford's CEO spoke with senior Trump officials about a potential framework for Chinese automakers partnering to build cars in the US. Sources say the idea involved joint venture deals in which the US partner would hold a controlling stake. The agreements would be structured so both the Chinese and US firms would share profits and technology. A2 Milk has boosted first-half earnings and raised full-year revenue guidance as sales in China continue to strengthen. The New Zealand-based company now sees a mid-double-digit percentage increase in full-year sales, up from the low double digits previously. Sales in the key China formula market increased, boosted by increased birth rates in 2024. Australia's Treasury Wine Estates has reported lower than expected revenue, citing US supply chain difficulties and adverse consumer trends in China. The maker of the iconic Penfolds brand reported a $458 million first-half net loss, compared with a $156 million profit a year earlier. Now, it's also suspending its interim dividend payment to prioritise preservation of capital and reduce leverage. A quick programming note before we go. Insight's going to be off air as well for the next 2 days for the Lunar New Year holiday. We'll be back on Thursday, live from the India AI Impact Summit in New Delhi, and you'll hear from Mistral's AI Arthur Mensch, Google DeepMind's Demis Hassibis, and Google and Alphabet's James Manyika. Plus, we're going to speak with Schneider Electric CEO Oliver Bloom. That is it for Insight, though. Horizons Middle East and Africa are up next. This is Bloomberg.